So it's for him, he's signing up for Chumo.
Yeah, correct.
Okay.
Okay, so let's begin and let's talk about our first lecture. So we are officially starting our principles of accounting or financial accounting. So our first chapter is financial statements. So financial statements are the documents basically of an organization which are used by the parties like investors, stockholders, government agencies. So there are many others, so that they can make their decisions based on the financial documents of a company. So I'm not going to be repeating that what is company and what is the all the stuff, but we will be including just a touch. What are the categories? What are the kinds of companies like that? So we'll be discussing today, but not in detail as you have studied in Introduction to Business. So our first learning objective is explain why accounting is the language of business. So as we are speaking and we are listening, the language or the medium of instruction is English. So does the business have its own language, and we call this accounting, right? So what are the benefits of having the language of the business? So even if you are in Japan, in China, in Russia, in America, in Norway, in Korea, whatsoever, if you have the financial documents that I have in Pakistan, in US, in Russia, it looks the same. If I send my company's financial information to a person in Norway or in Russia, so both of us will be having the same understanding that what does it mean by, okay, this profit. Okay, what is mean by this profit percentage, how it is calculated, and how we should record our transaction, right? So even though I cannot speak the Norwegian language or Japanese language, I'm not good at mainland Chinese, the Mandarin language I'm not good at, but still I understand when I am to be presented the financial documents. We'll talk about what are the financial statements. There are 3 kinds of financial statement. We'll talk about 4 kinds of financial statement. We'll talk about. So I understand that. What does it mean? And I can guess that whether I should make my decision whether to invest in that business or not based on these financial documents, right? So accounting is an information system. Why? Because it gives you information about the company. What kind of information? Of course, financial information. Okay, because this is the language of the business. So number 1, it measures business activity. What is business activity? You pay the money, you receive the goods. There is kind of like transaction. There is kind of activity, and whether this activity is good or bad, we'll talk about that. But it should be measurable. Okay, this pen is worth of $10. It means the transaction is going to be measured in terms of dollar, right? If it's yen, it's yuan, euro, pound, right? So it is measuring the business activity. Number 2, processes data into reports. All the transaction would be, then converted into reports to look, it's a summarized report. So that reports are giving you too much information. You can just look at the reports and you can find out that, okay, this is good business or doing bad. You can compare to your own business as well, because business speak the same language, which is accounting, right? Number 3, communicates result in decision makers to the decision makers. Like I told you, if I have to invest in different companies, one in China, one is in America. So I have the reports, and I can find out through comparison or through different stuff. We'll talk about different comparison stuff. So, and we can just decide where to invest. Or if the decision is that which one is bad, which one is good, or which will be having some kind of financial trouble in future, we'll decide based on accounting reports, based on the language of the business, which is accounting. We can find out that, okay, whether which company is having a cash problem, which company having a problem that the customers are not paying them back, right? This kind of stuff. So all of these uses of this accounting, it communicates some kind of language, and that is the language of business. So accounting is the language of business, right? Any question regarding this slide? Okay, now let's talk about the flow of the accounting languages. First of all, people make decisions based on accounting data, accounting reports, accounting numbers. What happened then? Business transaction occur. When business transaction occur, it is reflected in the company's financial reports, right? You can see the lady is putting something in Excel, and those results are now then again sent to the public. Again, this loop occurs again. People make again decisions to invest or to buy, to supply goods, right? Even if you want to work with that company, you can see the financial statement and you can just realize that, okay, the company is good, it's having previous 5-year presence, this company is making good profits, I should start my career with that company as well, right? So all these things, these steps based on accounting. So that's why we can say that accounting is the language of the business. Now, who uses the accounting information? Individuals. How the accounting information is helpful for the individuals. Number one, if you want to manage the personal bank account, you use accounting information, right? Even the bank in Pakistan, bank in Norway, bank in US, they all give you the same information. The ATMs look the same. You just, if you have a bank account from Bank of America and you are using that in China, the same kind of structure is there. Okay, you want to take out the money, you want to deposit the money, you want to convert it into different currencies, just like that, right? So accounting information is also good. Plus, it helps you to decide whether to rent or buy. Plus, budget monthly income and expenditures. You can also use that information according to your own personalized perspective, right? Investors and creditors. What are the investors? So investors want to know how much they can earn on an investment. So investors, basically those who provide money to the business. And why they provide money to the business? In hope, so they can get some kind of profit, so that they can get some earnings. So the amount they invest in the business is called investment, and how much they are earning on the top of that investment, we call that profit or return of earnings, right? So investors provide money to the business, and what are the motives? So that they can earn some money, some profit, just like that. Creditors, they are also those who provide money to the business, but their focus is that so that their money can be paid back to them. So it's like a lender. You provide money and you hope that you receive your money back. The difference between investors and creditors is that the investors are risk takers. They invest the money with the viewpoint that they will earn money on the top of that. Creditors, they are also risk takers, but less risk takers because they don't care about the loss, they care about their money. We invest money with the point of view as a loan provider, and all we care about some 10% return, fixed return, as a like interest, and also we care about the safety of our money, that you will be able to pay us back. So this is the difference between investors and creditors. The regulatory bodies. So basically this book is US centric. So if you hear this kind of word IRS or SEC, so don't just confuse, you can replicate to your own country perspective. In America, there are IRS, which is Internal Revenue Service, which is FBR, which is their Federal Board of Revenue, who collected taxes and all those stuff. So the government body, they see the financial information and they see that, okay, you have to pay taxes, or your companies now fall into taxable category, and how much you are paying taxes. Okay. And also the Security and Exchange Commission also require companies to publish their financial reports. Specifically, those which companies? Public companies, right? The private companies, it's optional that you publish your own data that, okay, we are making this much profit. For example, the sweets or the bakery or the noodle shop, for them it is optional if they want to publish their data, okay, we are earning this much money. Otherwise, this is not required. But if this is a public company, it is must for the company, according to the government authority or government bodies, which is SEC, that you need to provide publicly, which means I can access the data, you can access the data. You can go to their website, you can download their annual reports, right? So also, the user of the accounting information can also be the non-profit organizations. So even though their motive is not to make profit, but even then, they can use the financial information to file periodic reports with the tax authorities and with the government, and how much fund we need. Or you can apply, if the NGOs, non-profit organization, they can also apply for tax rebates. It's like that. So they are also using the financial information systems, right? So there are two kinds of accounting. Number one is financial accounting. Number two is managerial accounting. So there are difference between these two. Financial accounting, which is right now we are studying. Financial accounting is used to make decisions, or for decision makers outside the entity. So you don't see the users of financial accounting information as employees. Did you see the word employees here, or the management here? It means the financial information users, they are the one who are outside the company. We call this outsiders. So financial information users, they are not the insider, they are outsiders, investors, creditors, government agencies, the public like you and me, right? Whereas the